Hey guys, welcome back to the Capital Mindset Show. We are your hosts with the most, Austin and Fabio. And today we have a fantastic video for all of you guys on Alibaba. We've been receiving some wonderful comments that have been driving the conversation forward, that have been points of criticism to our recent Alibaba videos that we've been making. And first, I want to start by saying we absolutely love when you guys criticize us because it really drives the conversation forward. And this is an issue that we're passionate about. So the way that this video is going to work today is that there's a lot to unpack here in these two comments. So we're not going to disclose who these two people are, but thank you so much for lodging these comments, because now we can kind of actually properly respond to this in our best ability. Yes. So the way that this is going to work is that I'm going to be reading these comments, and then I'm going to be sort of offering, I'm going to be trying to play the devil's advocate in this instance. So I'm going to be sort of putting myself into the mind of these commenters in the best way that I can. I'm not going to try to straw man your arguments if I literally don't understand what you're, yeah. Like if I understand the argument that you're making, then I can defend the argument. And that's basically how this is going to work here today. And then, Fabio is just going to be Fabio and it's going to be like, oh. So without further ado.
That's not me. Well, I also have a surprise later, but also like these videos, the reason why we do them in this format is we want to provide value in our channel in terms of teaching, right? Or something that someone can learn from. And then at the same time, it's also working as a interesting conversation between us and I. We love this kind of stuff. So if you disagree with us, we actually love if you guys would respond in the comments and tell us why you disagree. And then we can probably address those in the future, because if anything, it's providing value to all the viewers in this community. And that's what we're building here. So it's a place where you can get, some free lessons completely free. There's who pays.
So, we pay with our time.
Well, but I mean,
is
it really because we love it.
It is the best time well spent, Now that didn't make any sense, but basically what I'm trying to say,
we're having our conversations, but we're putting a camera
our
in front
time.
of it. Yeah,
exactly. And then also too, we're not attacking you in this video. There's no criticism or a question that's stupid. We love this because it really drives the conversation forward. So I want to just disclose that again. By no means are we attacking you guys.
I like everything money. I do. Yeah. But I won't say, like, for example, what Paul says about people being stupid. So don't worry. You can say whatever you want. I won't think you're stupid. Because I distinguish what stupidity is from intelligence. Okay. So some people equate the two as the same thing. I in my definition, I don't equate them the same thing. But criticism, it's not inherently stupid. So, or me being right, you being wrong, you being right, me being wrong, it's not going to have that kind of effect in my mind. So again, it's not actually, that's not a dig at everything money or anything like that, but
no. And it's
please
sort of just really
disagree with us and tell us why you disagree. That's what I'm trying to
say.
All right, let's get started.
Yes. All right. So the very, very first comment here, we're going to be keeping you guys anonymous, just like we have disclosed that we would be doing so. I'm going to be reading the first part of this comment here. It's a fantastic comment, by the way. Alibaba and Tencent are critical companies for China. They have the potential to expand globally and propel China's growth. If China somehow invalidates/breaches the VIE structure, they would basically become uninvestable for the international market for the foreseeable future. Doing that, all the international capital would get diverted to their strategic rivals like India. So why would the CCP do that and make China internationally isolated? Point number 2, regarding buybacks or dividends, why should a growing business like Baba Tencent pay dividends or do buybacks? The capital would be much better off invested in future growth engines like their cloud business. If you look at Amazon, they have neither paid a dividend nor did buybacks in years. So why should Baba Tencent do that when it is clearly an inferior capital allocation strategy? Right, Baba's management are doing 15 billion buybacks. By the way, given the current valuation, it would make huge sense. And then there's more here, but this is the first paragraph.
Yeah. So I will just be, I think it's kind of funny that they that was said, and then they said that they're doing a buyback. But I had to address that buyback because that buyback, it's very important. It's actually, I'll quote Michael Burry when I address the buyback. But for the first part, they're not invalidating the VIE. I want to make this very clear to everyone. Do not think my argument is the Chinese government will invalidate the VIE. They will continue the VIE structure for 1,000 years if possible. There is zero reason for the Chinese government to invalidate the VIE. is if that is your primary concern, we'll dispel that concern. Okay.
Okay. So if I'm understanding you
Mhm.
correctly, and correct me if
Yeah.
I'm wrong, you're not saying that they're going to invalidate the VIE by not returning capital to shareholders.
Well,
Wouldn't that be inherent of that process happening in and of itself, unless there's a
no,
stipulation in there that says that they never have to return that capital?
well, there's no direct stipulation in the VIE structure that says that, but
Mhm.
the invalidation by the government saying that it does not exist or it's illegal, that's what I'm talking about. They're going to keep it the way it is, because the way it currently stands is, as you kind of touched upon, there are no stipulations on return of capital. Because I tried to drive this home with an analogy. If you think about it like a business, like a private business, and if I could sell you something and give you nothing in return for 1,000 years, what is the value to you? And then let's say you were to sell those shares in this business, and that individual who bought them off of you would also receive the same treatment, right? They would not get anything forever, right? And then I could continue to sell these, whatever we want to call them. Let's call them VIEs for this example. But I want to be careful, because there are American VIEs, and we've covered American VIEs. And some American, because VIE is a umbrella term for a structure. It's a creative structure. Variable, variates, variable interest entity. So they can vary in terms of how they look. And we've looked at some in the past. Rocket companies is one that we looked at. So we did a video on that one. You can check that one out if you're curious about what an American VIE looks like. Another one is Dutch Bros, by the way, but we haven't done a video on that one. I don't want to get too carried away with that, but
yeah. So this kind of brings to the second point that he just made here regarding buybacks or dividends. This kind of comes down
there's one thing that I have to cover first.
Yeah.
Which is the question, Austin, because you're being devil's advocate. And this is the point I want to stress. At which point is the VIE invalidated? When do we say the VIE is invalidated? Because there's a key point in this question. All right. The problem is, Austin, you won't be able to answer that question.
Yeah. Well, also too, I could say the VIE is invalidated when the company itself does not decide to return capital to shareholders.
What do you mean by that?
How
do you know when
exactly
it is?
what it sounds like it means.
But how do you know when it is? You won't know, because it's not an annuity agreement. It's not a royalty agreement. It's not a bond, right? And those are separate. I want to actually separate those. So Chinese bonds.
I actually think I might understand what you're saying. So what you're saying is that there's, like you've been saying, there's legitimately no time horizon. There's no time horizon. Interest payments on a bond.
There's no stipulation.
Annuity. Yeah. So
they can continue the game for 1,000 years, and you probably will still have the same exact arguments.
Okay, so they're not even invalidating their own structure because there's no stipulation. So it's continual. It's continued to be validated time and time again, except for the fact that they've not even stipulated when they're going to return this capital. Okay, now that makes sense. So you're not even saying that they're going to invalidate the VIE, because then this comment here would be true. China would not become investable. However, it will continue to be validated because it's not stipulated in these contracts. China will return capital.
China has perhaps the best deal in the entire world when it comes to raising capital. The best. Okay, because essentially what they're able to do is sell and raise capital and build their businesses up without giving up ownership. That's the best.
Yeah, move the mic away a little bit. Yeah.
So if American businesses could do that, that'd be wonderful, because then the cost of capital would be reduced to nearly zero. Because I mean, sure you might have to, because they can't just rely entirely on the VIE, because again, the VIE, they have to coddle you. They can't just dilute the absolute living, crap out of you. They have to kind of do it little by little by little.
Safe.
Well, okay, but we're not monetized yet, but I want to, avoid, because maybe children are around. So a little by little, they have to sort of nibble that way at it, right? But they can raise that capital over time, and it's basically free capital because they're not giving up any ownership. And the point that I was driving before was that the VIE has no stipulation in it as to when they must return capital, because every business, the only value it has is inherently the capital it will return to you at some point in the future. It may not return capital to you at the very moment, right? But you're buying the potential that it will. However, with a regular share there is a reason why a company has an incentive to. Well, because you have ownership over it. You have control over the business. You, in aggregation with all of the shareholders, control the business. You own the business, right? Own, control, own. So a company, a regular company, has incentive to reward the ones who control it, the ones who own it, okay? And in the West, or in the rest of the world, when you own a share and the CEO owns a share, when they distribute a return of capital to one share, they must do so to all shares. Okay, so you have like also equality of treatment among the shareholders.
Okay. So basically,
and that's separate from voting rights. This is
if I
economic
understand
rights.
what you're trying to say here is when you're an actual owner in the business here, and that's really kind of the axiom that you're operating from. Investing is about owning businesses, whereas what I'm reading here, investing is about the returns that originate from the price go up. I don't mean that in a derogatory form. There's literally no other way that I can say that. Price go up, therefore returns. But you're operating from the assumption that investing is being an owner. So under that assumption, now companies are incentivized to return capital to these owners of the business in some form or another. So if you can't own these businesses,
there's no
what incentive do they have to return capital? They don't have any.
Also, you got to be the devil's advocate. You can't agree with me.
I know. Well, actually, I'm trying to understand myself, because this is a very complicated concept.
Yes.
And like this is raw too. Like I'm actually like digesting a lot of this information.
And Austin and I have been talking about this for an extensive period of time now, and he's still you can see how it's complicated. Don't get it. And we've done so many videos. You may ask, why are we doing so many videos? Well, you can see like Austin and I have talked to each other more about this topic than we've made videos about it. So I can only imagine for the audience, they're seeing this raw, and I don't see really any other creators covering this. I see other institutional investors sometimes cover this concepts, but not in any deep way. They kind of do like little brief interviews and stuff, but unfortunate. But that's why we're hoping to really get this information out there.
Okay. So now we're moving on to the next part of this comment. And it's also this notion that investors don't get anything in return for their investment in Chinese companies seems overly simplified. If you look at any long-term investor in China, their returns, which is exactly what I was talking about before with the ideology of price go up. Again, that's not derogatory. That's just no better way I can explain that. The returns have been phenomenal, be it Munger's BYD investment or Kuzbecker's Naspers Prosus investment in Tencent. Having said that, China does have their own way of doing things, and one must be comfortable and aware of these issues before investing there. For me, I am grateful to have this opportunity to invest in these great Chinese companies and participate in their growth. Over the long term, greater than 10 years, there is no reason that a young investor should not diversify their portfolio into China. For all we know, the USA might turn out the riskier one with the debt crisis and currency depreciation.
Wonderful. Okay, so there's a lot in there I agree with. So for example, it may turn out the United States is risky. I don't disagree with that, but that doesn't that doesn't equate to the other. So for example, you kind of addressed it how I would address it. So the point of these returns is simply price go up. So as prices go up, that's simply operating under greater fool theory. It doesn't actually prove the intrinsic value of these businesses. Now, I want to actually separate that. There is value in the business. If you were an actual shareholder of the business, you'd be extremely wealthy and you'd be in a very privileged position.
That's actually what I was literally about to ask. If you could elaborate on the concept of intrinsic value being rooted in actual ownership itself.
If you can't own the thing. So for example, it's like saying, I'm going to sell you a house, but you can't live in it and you can't rent it. What's the value to you? You can only hope that someone else is going to buy it from you at a higher price. So you see like the problem. And then let's say, if you sell it to someone, they have the same arrangement. They cannot live in it and they cannot rent it. So all these guys are just passing over this piece of paper, right, that says that they own the house, but they don't actually own the house. And let's say another guy has actual control and they can rent it and they can live in it. So who is the real owner, right? Semantics are at play here, and the real owner is perhaps the one who has control over it. So there is an incentive, for example, you have to pay attention to the incentives at play in terms of who's going to get the rewards or the fruits of the asset. All right. And then that's going to be what we can kind of attribute to being the owner. So the other part is what was the very beginning of the comment? Just the very beginning. And I can remember what it was.
This notion that investors don't get anything in return for their investment in Chinese
simplistic.
Seems,
the problem is the actual simplistic argument is simply attributing the Western idea of businesses and business ownership to these Chinese entities. That's the simplistic argument. If we're being honest here, that is the simplistic argument, because you're applying a framework from one nation to another, okay? And it is the complex argument to then decipher that there is a massive difference between the structures of these entities. And then to then say the difference is so vast, right, that we cannot apply our Western normative ideals to these entities. We must actually look at them in isolation, and then from that derive conclusions unique to the existence of these entities. Okay. So that's a bunch of word vomit. In English, the West is a system. China is its own system. My point is acknowledging that there is a vast difference between the two. The point of ignoring the VIE structure and simply investing in this is an assumption that you are making, an assumption that you are the same. You are treated the same. The end result will be the same. Really? The end result will be the same? You're just buying into this VIE, Baba, Tencent, et cetera, and you're going to have the experience the same results as the United States in the past 100 years. You're ignoring that the systems are vastly different. So if the equation, like in math, if the linear formula is different, your input is going to get you the same output. See the logic break?
Yeah.
Am I making it in a simplistic argument?
Because it actually makes perfect sense.
So I'm trying to break it down, but yeah, the simple argument is simply saying, oh no, don't worry. It's the VIEs, don't worry. It's a cheap business, which will show in the model, by the way, in the later part of this video. If you stick throughout the end of the video, we'll show you in the model. And if you just want to follow the model, you'll see it.
Yeah. And that actually makes sense to me. The comment that you brought up earlier about a lot of people in the West applying a Western ideology to the East, the Chinese market, let's say, and that's actually if I can materialize the words that I have in my mind correctly, that's kind of a true instance happening here, because people are saying, oh, this is a growing market. If this is a growing superpower, why not invest into this? I
want to use some anecdotal evidence here.
Yeah.
Can we use some anecdotal evidence? I think it's fair to say, Austin, that both you and I, we went to high school with the children of the CCP. We actually never said that. This is the first time we're going to say that. We literally went to high school with the children of the CCP.
Actually, and like they were great guys.
Yeah, very nice people. I actually still have, nice people. I'm still friends with some of them, actually.
Same, yeah.
I'm not going to say names. I will not say names. But we were privileged enough in our youth to go to a very nice high school, and that is actually just so happens to be where a great number of CCP individuals sent their children to the United States to go to school. And we got to know a lot of them. And I mean, let me just say, like, I've never seen so many individuals so flush with cash, by the way. But let me just say,
but like, also they were great
as
guys,
people,
too, and they were great people.
Yeah, they're just like they're kind of just like regular kids, but
children,
the point is, we got to know a lot about their nation. I think that was also an incentive to go to that school, because you got to learn a lot about how different systems work. And then we had, if, for example, they were in my economics class, had a lot of these kids, and they shared their perspective on the different systems. And this was in early 2010s, very early 2010s. So I got to learn a lot. I really enjoyed that experience. And I think, for example, that's carrying forward now, but that's anecdotal evidence. I understand that there is no way, and me not sharing names is not going to be giving any proof, but you got to understand my perspective. So, and it's not that I, have an aversion to China whatsoever. It's an understanding that the systems are different, and I'm not applying the same framework of the West. And I think that's where a lot of these super investors are basically at folly, where they're making a mistake. It's they're applying the same framework that works everywhere else in the world, essentially, even in Russia, but it's not going to necessarily be the same in a system that's vastly different. And that's the argument. So the argument is not simple, right? The simple argument is ignoring the differences. And then my argument is actually addressing and saying, hey, look, they're very different. This is apples, this is bananas. And I've said that analogy before, but I hope in this video I'm being a little bit more detailed. Right. And I'm sharing this new information that it's a little bit anecdotal evidence, but I did kind of grow up more or less with a lot of children of the CCP around me.
Yeah. Okay. Well, with that being said, I think that you've illustrated this perfectly. Let's move on to the next part. This is a longer part here too. So
Yes,
stop me if you
I'll stop you to answer the parts of the comment.
Okay. Yeah. So I see your point, but given that the VIE are here to stay, I don't think it is such a big deal. Your primary concern is really the ownership thing, and I get that. We as foreigners to China are not really owning a Chinese business when we invest in Chinese companies. Having said that, is this such a huge issue to completely avoid China?
All right,
I don't think so. Yeah.
So there is a highlight of where I say, if you don't think the point of investing is ownership, then you can come to the logical conclusion that investing in Baba is okay. And I'm okay with that, because that's where we can have disagreements on, like, for example, what are the facts, or what are the philosophies?
Like what are the definitions of like what is investing?
Exactly.
Yeah,
So like,
because this here illustrates to me he has a different belief in what investing is compared to you, and then more so me as I'm starting to continue on this journey.
And that is just a difference in philosophy. So this individual who commented is still operating under a logical framework. Okay, so let's be very clear. So it's like, if their axiomatic belief is different from mine, and then they're deriving from it a logic tree that may be different from mine, as long as there's no breaks, that's okay. That's fine. We just disagree on what, for example, what is investing and what is the underlying or bedrock philosophy of investing. And mine is ownership in businesses. Right. But if you have that same philosophy and you're buying the VIEs, that's where I'm saying you have a logical break. There's a logical break occurring in your thesis to invest in that. You're doing something to justify your investment, not following your logic path and then justifying the investment. You're creating new reasons to invest. But if you don't believe that investing is ownership in businesses, then of course you can actually logically come to the conclusion that investing in Baba is good, and you should do it. And that's fine. Right. But we just have to acknowledge
it's all about driving the conversation
and
forward.
That's where I wanted, when I ask questions in the comments for people who disagree with these statements, I'm trying to actually pinpoint, and I think we are, that there is a fundamental disagreement in what is, and that's, again, completely fine. It's the market. The market is the market. All right. So
I guess more. When we buy Chinese stocks, what are we buying? As you rightly pointed out in your videos, we are basically buying some shell company in Cayman Islands. But think of it this way. Where is your capital going? It goes to the business, which gets this funding. And these businesses then deploy that capital to expand and grow the business, arrow, which means the business becomes more valuable, arrow, attracts capitalists worldwide.
Pause there. So
hold on. Actually, attracts capitalists worldwide, arrow, higher stock price.
Okay, there we go. So we're actually breaking it down. The higher stock price is attributed to the betterment of the business, right? That's true when the price of the stock, or the stock, is directly connected and correlated to the business. Now, the problem is, again, the whole market is, or not the whole market. Well, still the market is still operating under the axiomatic belief that it's the same framework, right? But it's not. So the Western markets are applying the equal framework of the rest of the world to China. So therefore, the market doesn't actually perceive it to be different, right? They still perceive the VIE to actually be ownership, when in fact it's not. So that's how I'm telling you that the market's actually not pricing in the VIEs are not ownership. Some people think that is applied. No. There's an inherent VIE discount. Okay. So like Rocket Companies is an American VIE. There's an inherent discount that you can see in the price of Rocket. Rocket will always look cheap because it's a VIE. However, there's more than that. So in Rocket, you have actual connection of economic interest. Even though it's a complicated structure, you do have connection of economic interest. In the VIEs of China, you do not. There's no such connection. There's actually no implicit guarantee of distribution of return of capital. While in Rocket, there is. Okay. In Rocket, if this is not a Rocket video, but if the larger owners of Rocket want to pay themselves out some form, they must also treat the Class A shareholders the same way. So there is that inherent ability to derive value in Rocket, even though it's a VIE. And that's to show you that the VIE isn't inherently a problem. It's actually very nuanced, right? So as everything in investing, things are more complicated than they seem. Blanket statement of VIE bad isn't really true, right? Because then I'm plugging in all these other things. But I want to separate them. And then on top of that, I want to separate within China the different asset classes. So like bonds, royalty agreements, et cetera, all those things. I want to separate those, because if those have definitive stipulations on when you must be paid, et cetera, et cetera, et cetera. So those, they have to be worried about actually meeting those obligations. The VIE, they can go 1,000 years and not return a single dollar to you in capital, or return net negative. And I'm very careful with my words, net negative, because I have to address the buyback, right? Because I didn't even address the buyback in the previous comment. But the buyback of Alibaba can be chump change for all these years, right? And which is funny, because I don't want to say funny in a derogatory term, okay, but I just want to like address this so we can think about it together. They were supposed to invest the money into growing the business, but then instead they're going to be doing the buyback, which you believe is an adequate form of capital allocation. I've addressed this in many videos, that I highly expect all these VIEs to coddle you. They're going to release statements or release plans to make you feel encouraged to own the VIE. They're going to do that. Okay. And one way they do that is giving you a little buyback that they're going to execute over time. They don't do it all at once, over time, but the dilution amount will be greater than the actual buyback amount. They're going to give you a net negative capital return. Amazon is not comparable to VIEs, because Amazon, when you buy Amazon shares, long Amazon, by the way, when you buy Amazon shares, you are buying an entity, right? And you're buying ownership in that entity. If Bezos ever wants to give himself capital returns, he must give capital returns to all the shareholders equally in proportion to their ownership of the stock. In Alibaba or all these other companies, that's not the case. I am not even getting into the laws regarding capital restrictions of exiting capital in China. I am not even touching that, which is an added layer to this. Okay. So if you think everything I'm saying is kind of complicated, just wait. When you get into the capital restrictions in China.
There's more. But
wait, just wait, there's more. And we're probably not going to get too deep into that in this video. But I've addressed it in other videos a little bit. And then that actually affects American companies doing business in China, which makes the whole thing even more complicated, because you have to even address even more little nuances. All right. But anyway, and it makes valuations a headache. Okay. It makes them a headache. When I find out a company is doing business in China, makes it a headache to actually come up with a interesting valuation. All right.
Well, I don't even think like the FASB's really caught up with that yet.
No, it hasn't. No, it hasn't. No. And that's the point I've addressed in other videos. The FASB, the regulatory body for accounting,
that creates GAAP. Basically. FASB creates GAAP. Easiest way that we can say that. FASB creates GAAP.
They have not addressed these discrepancies in the cash movements or cash equivalents, right? But that's not a video for this. This is not that kind of video.
Yeah. So we can
the $15 billion buyback
restrictions.
It's chump change in relation to the total amount of dilution that's occurred, and it will be for a long period of time, because there's no incentive, there's no reason. You're not a shareholder. The shareholders are in China.
Now, actually, another very interesting point that I think he raised here is when he was he outlined his entire logic tree here, and then he said higher stock price. That again goes back into the concept that we were talking about earlier, whereby Fabio in this instance is defining what investing is, owning businesses differently than this individual is. And that's like you just said, that's
separate
okay,
axiomatic belief.
as long as there are no logic breaks here.
Yeah.
So anyways, let's continue. This is a very, very long paragraph. Basically, why is that not something to be concerned about? Well, let's take the example of the US. Let's say a person invests in US stock, which trades below its liquidation value or below working capital. Think of it with the perspective of a small retail investor. If the business were to liquidate, do you really think that greedy corporates would let you have your capital back? Would corporate US care about the small retail investor? Things were different maybe 50 years ago. Now, I don't see any chance of it happening. Maybe one gets some pennies on the dollar back, perhaps more than you would get from a Chinese company. So the way I see it, it boils down to a mindset question. It does help to think
pause there. So that's an interesting comment, because if it's below the intrinsic liquidation value, you're assuming creditors as well. I would say absolutely not. Okay. So you will get the capital relative to the actual liquidation value. If your calculation of liquidation value is incorrect, that's not their problem. That's your problem.
Yeah. He's also saying below liquidation value or below working capital.
Okay.
There.
Well, but let's stick to the liquidation value. So, if the liquidation value, if you calculated it properly and you see that a company is trading below liquidation value, that's assuming again that all creditors are then paid, right? Because you have the totem pole of priority, and then the common stockholders are near the bottom of the totem pole, right?
Yeah,
So
underneath the creditors and the
exactly
preferred shareholders, right?
So yes,
Yeah.
preferred shareholder, because preferred shareholders are, that's debt. That's another form of debt, but it's less
Mhm.
senior than bonds. So when you take that into account, if you calculate the liquidation value properly, then you will get the money. There isn't, you have to find me a case when the liquidation value is calculated properly, right? Find me that case, and then we can talk about it. But you won't find that case because that's, for now, the United States legal system, you have property rights, right? And that's property rights. That's governed under property rights. Your ownership in businesses is governed under property rights. I can't, for example, create a business, have Austin have some shares, I control the business, and I just liquidate it, and then there's no consequences to me. No, Austin will have a lot of ability to come after me for me doing that. Or better yet, I pay myself a dividend and not give any to Austin, even though he owns shares. I have to treat him equally.
Yeah,
in proportion to his ownership.
also another thing about this too is that typically when situations like this happen, a lot of law firms sort of jump into these situations and they'll create class action lawsuits on behalf of these small retail investors.
It's not even that. We actually get back to the argument of if they even thought about doing that, it would make them uninvestable. So for example, the United States has a huge incentive to enforce that because it makes their companies investable, right?
Yeah.
So if the US law system or legal system does not properly enforce the property rights, right, of individuals, it drastically decreases the incentive to own said property in that nation under that jurisdiction. So, right, even in Russia, I'll say this, I own Gazprom. Even in Russia, your property rights are protected because they have an inherent incentive to protect those rights because it attracts capital, right?
Mm-hmm.
Now, the VIEs are vastly different because for the most part, it's even funny because courts have ruled in the past that you do not own anything. We've seen the Ant Financial debacle, which we'll talk about, I guess, in a second. But the West, for now, has the perception that they have those rights. And as long as that's the case, China can continue this game because they're kind of just getting away with it. And it's amazing for them. You don't understand how great this is for them. This is perhaps one of the things that's propelling their industry forward the most. The ability to raise capital at a zero cost, right? And you have this ability for all these foreign investors to believe that they're partaking in this. And then again, a lot of the arguments that I always see this argument is the growth of China. Growth of China, you have to participate in the growth of China. Great. Yes, China's growing. Yes, but at what cost are you participating, right? Are you just jumping in because you're blindly thinking, like that's, what's that called? No, not self-confirming evidence. What is that called? Confirmation bias. Yeah. Exactly. You've created a, you've already come to a conclusion, and everything that's coming across is just confirming your previous assertion that you must invest in China because China is the growing market. China is the upcoming power. You've already concluded that, and then everything else, you're just kind of just ignoring it. You're making excuses for the other thing, unless you're operating under the axiomatic belief that, you know, ownership is not actually what investing is all about. Investing is about buying something and then selling it for more. That, if you believe under that, you're still following the proper logic tree. If you're under the logic tree of your axiomatic belief that investing is ownership in businesses, and then you're still continuing to buy something that you're not really owning, you're breaking that. You're creating excuses at some point to then jump a bridge and then get to the next block in your logic tree.
Yeah.
Right. Next part.
So continuing on from here, and I got to see if I can find my place again.
Yeah.
Yep. It does help to think of oneself as a part owner of a business. You simply don't have this luxury when it comes to Chinese stocks, and that is just how it is.
You see, okay.
China is a different country.
Yeah. That was an acknowledgement of the fact that you don't own Chinese stocks. All right, continue.
Yes. China is a different country. They have different rules and laws, and they do things differently there, and one simply has to accept that.
Agreed.
I guess when it comes to Chinese companies, you would have to think of yourself as a investor rather than an owner.
There you go. Perfect.
Yeah. So he is defining it differently here. Yeah.
Exactly. Yeah. Perfect example of a disagreement in the definition of investing. So he separates ownership from investing.
Yes.
That's fine. That is fine. But we have to acknowledge that that's the difference. And then if you're operating under the belief that investing is not ownership, that's fine. If you're operating under the belief that ownership is investing, think about what you're doing by investing in VIs. Right? Continue.
Exactly. All right. There are all kinds of risks involved in investing everywhere. One has to simply weigh the risk reward. In my opinion, the reward far outweighs the risk in investing in China. Following the principles of Buffett Munger, one should have the bottom-up approach, finding great businesses at fair prices.
Agreed.
That's all that really matters. So I do believe young investors should diversify their portfolio into China and not worry too much about technicalities.
Agreed. Okay, cool. I agree with all of that at the end. I just think it's being applied incorrectly, in my opinion. But I
because
agree.
You're operating from the different definitions.
And that's what everyone needs to understand. I'm operating on a different axiomatic belief of what investing is. So this individual is not doing any logic breaks, right? They just disagree on something fundamental that I would disagree with them on. Okay.
Yeah.
But if they're operating under that belief, and then they're being consistent. What I'm trying to say in English is they're being consistent. All right. So was there any part about financial?
There is in not this one here, everything here. This is the next part of the comment as well. And he says, to answer your questions, 1, I don't look at it as VIE being validated or invalidated. If the business that I invested in doesn't perform as expected over long periods of time, then I would consider my investment a failure.
All right,
2,
pause there.
Again.
Wait, pause there. We'll address each point one by one.
Yep.
All right. So my problem with that, and I asked those questions, and this person was very nice and answered them in full, because that allows me to kind of gaze into how someone's thinking or in disagreement with me, which again, we preach in this channel that you want to find people who disagree with you so that you can either strengthen your points and see where you're missing, or you can see, okay, I'm wrong there. I don't have an answer to that question. So that's how I can kind of tell if I don't have a proper answer, then I need to rethink about how I'm thinking about a situation. So, so for the first part, it was, what was it again? I just went on a tirade.
I don't look at it as the VIE being validated or invalidated.
Okay,
if the business that I invested in doesn't perform, then I see it as a failure.
Okay, so what does it mean when a business performs? Is it a failure? Are we talking about the stock price or the business itself? I'll assume it's the business itself.
Actually, operating under his belief here, I actually believe that it would be the stock price in this instance.
Okay,
yes, and well, actually, if
I'll address
it
in both,
this video,
just in
please
case.
correct me in the comments below.
I'll do this. I'll address it in both perspectives.
Okay.
So the first perspective is if the stock price is what someone is looking at, then I mean that one's the easier one to kind of talk about. But that is because the argument is more simple against it. And it's because you want to actually make sure that the business fundamentals are what's driving the stock price, not simply the stock price is reflective of what you did. Because again, the reason why the business fundamentals are important in the first place is you're an owner, the ownership mindset. So again, if we disagree on the ownership mindset, then yes, the only thing that would really matter at the end is the stock price. And then you're still like discounting what the distributions are of capital are, or the return of capital, which at the end of the day, if you really break it down, inarguably, the actual value of any ownership status is the return of capital. When it's not returning capital to you in the moment, you still have the value in the sense that you have the potential, right, in the future. So if I could guarantee you that a business would never return capital to you, what is the value? You see, like you're just owning a piece of paper, right? If I could guarantee you, but the problem is you don't have that guarantee, for example, in the States, but you do have the proper incentive to receive return on capital, as I addressed earlier in this video. You have the incentive to receive return on capital because
you are an owner in that business. Yeah.
Yes. So despite like Google, Amazon, for a long time, they weren't, well, Amazon still hasn't really, but Google wasn't returning capital for a very long time. Now they are. Now they're doing tons of buybacks. What was the value when it wasn't returning capital? Well, you were buying the potential. You wanted them to grow and grow and grow. And then as that growth continued and grew and grew and grew, all that potential return of capital grew with it. So the value, the intrinsic value of the business was growing because you own the business. And then they had an incentive to return capital to because you are an owner. And then effectively in aggregation, when you combine all the stocks together, that is the entire control of the business. And by the property laws of the West, you must be treated equally under the law based on your proportion of the shares outstanding. So if you own 5%, you get 5% of the capital distribution, right? Or the return on capital. Okay, so
all right,
separate that from the VIEs.
Second part, again, I would look at the risk reward regardless of the country for the second question there. So you
Agreed.
most likely asked him, I don't know, whatever.
What was
whatever
my
you asked
question?
him.
My question's in there.
I don't have the question here because this is in like a Word doc. So basically, I mean, he pretty much answered any sort of question you could have had. I would look at the risk reward regardless of the country. Okay, cool.
Okay, so what I agree with that statement though. Because if like, for example, again, I'm invested in Russia, right? And why am I invested in Russia? Because I believe the risk reward was adequate for what I was really getting at the time, and everyone just looked at it and just was basically spitting on Russian companies.
The fact that it was Russian, yeah,
for the fact that it was Russian.
Yeah.
And then I have it here. My second question was, if for example, if this was the same system in other countries, would you be okay with investing? And I asked the audience, so I'll repeat this question for everyone in the audience watching this video. If the American companies were all structured in this way, would you be investing in the American companies? Would you allow them to sell you something without giving you ownership, right? Because think about what I'm implying. I'm implying that the system as it exists today is actually vastly changed, and only a very select few will actually own the shares. And then everyone else is just putting money and giving money for these like little trinkets that basically say that at some point in the future, perhaps maybe with no stipulation of when, that you will share in the economic benefit. But there's, again, no stipulation to when. So technically 1,000 years can go by and they still haven't broken the contract, which I hope I expressed in a easy to understand manner, that 1,000 years can go by and they can give you nothing, just like regular shares. And by the way,
it's not invalidating the VIE,
and it's not invalidating the VIE, because the difference between the VIE is it's a contract, and the ownership or the regular shares is ownership in property, right? So the ownership in property, yeah, technically speaking, the business can be unprofitable or not return capital for like 1,000 years and nothing has been invalidated, but it's not a contract to begin with. The VIE is a contract, but the problem is it's a contract with no stipulations.
Yeah.
See,
I think that we should do a video sometime. So Fabio, we should actually do a video on the philosophy of investing and try to ascertain an objective truth about whether or not investing is about owning businesses or if it's about price go up, for lack of a better way to describe that.
Yeah.
And we can, and at least me, the way that I would try to ascertain that objective truth, this is sort of an aside before we go back to the video here, but the way that I would try to ascertain that objective truth is just basically if the law enforces the notion that investing is about owning businesses, the way companies respond, and then also
that's very nuanced. So we got to be very careful. All right, but
but yeah. Anyways, back to the question here. Question number 3: the Alipay fiasco in 2011 ended with a settlement where all parties involved were satisfied.
Okay, so that's actually a point I also addressed in other videos, and the problem with that statement is you have to understand this. It's a little more nuanced than that. Yahoo and SoftBank could not complain about it. All right, let me explain by that. So think about it like this, Awesome. You have an accounting background, and for you, that's going to click immediately. It's going to click immediately because you're going to think the word write downs. Yeah. So imagine that you're the CEO of a big company. You make a huge investment in another company, right? That other company does something to screw you, royally screw you. However, your balance sheet, a significant portion of your balance sheet is made up of that company, right? That investment, right? Now, the company says to you, hey, we're going to settle with you, and this is the amount we're going to settle on in our jurisdiction, because this is the only way where you can fight us in China. Remember that China has the incentive of not scaring the West with the VIEs. So the incentive is keep the VIEs going, right? Keep the West thinking that, it's okay, it's the same thing. Keep them looking at it from the lens of, from the Western lens of things are the same, but they may be different. So I have the incentive of keeping this alive. I also kind of want to take this away from them entirely, right? And bring it all under separate control because they don't own anything, right? But we got to also, coddle them. Okay. And then now you're the other company. So you're the company that invested in this. And now a significant amount of your balance sheet is tied into that business. Okay, so that business comes to you again and says, we can settle this. Now, what happens if you fight it? What happens if you say, no, we're going to fight this and we're going to complain and we're going to say that this is outrageous and you're uninvestable? What does that imply? What does that do to your balance sheet? What does that do to the valuation of your business now? You're a publicly traded entity. You have an incentive to keep the stock price from absolutely collapsing because you've contributed a significant amount of capital, or at the very least, at the moment of this contention, the value of that business on the books is very high in your balance sheet. What would happen?
Well, if you tried fighting them, there would be no settlement. You would have to write down the entire thing.
No,
basically.
but yeah, no, not write down the entire thing. Let's not be that extreme, but you would have to write down a very significant portion, because what you're basically proclaiming is that they royally screwed you, despite you owning, by the way, nearly half of the business, or I think they owned more than half.
It's like 40. It was like 40%.
40% of just Yahoo, right? If I have the actual statistic, it was, I think, 40% of just Yahoo. 40% stake. So Yahoo alone was 40% stake at the time. And then SoftBank, I think, was another 20 something percent. So imagine that you wanted to fight them and you wanted to basically shout out to the world, hey, this is uninvestable. What would you do? So what are your options here? You're the CEO of this business. You made that investment already. A significant portion of your balance sheet is valued in that investment. What are you going to do? You're going to take the settlement?
Likely not. You're going to try to fight them about
it. Austin, wait.
Yeah.
Why would you do that?
No, hold on. I'm not following. I'm getting lost in the sauce. If I'm understanding what you're trying to say, is basically if they take the business and you don't want to accept the settlement, then obviously
no, you have no choice to accept the settlement. You must accept the settlement.
Oh, because it's in the Chinese jurisdiction.
Because it's in Chinese jurisdiction, you have no chance of winning. You have zero chance of winning. And if you fight it, you're basically going to shout to the world that your investment, right, is worthless because you can't, you don't have control over it, despite having 60%.
All right. Yeah. Now I get it. So then that further exemplifies exactly what you're talking about, where investing is about really owning businesses. But in this instance, that's a concrete example of why you don't. But then that's also a concrete example too, just sort of like, I would probably say like management pride, why they would take that settlement and would not fight it in that instance.
No, it's not management pride, Austin. You're not
see how complicated this is? Like, I still don't get it.
Okay.
You know,
I'm trying to break it down as simple as I can. And the fact that Austin doesn't get it is indicative that I need to do a better job, by the way. And this is every time, like when people have these kinds of questions, I know I didn't do a good job. So if you are the CEO of a business that's publicly traded, your fiduciary responsibility is ideally to the shareholders, right? But let's think about it in a selfish way as well. You have invested stock options. So you want your stock price to meet certain metrics, basically go up. You want your stock price to go up. And in the short term, that leads to a lot of short-termism. We all can agree on that. So if you are the CEO of a company that's publicly traded and you made a significant investment in a company, now that company is worth a lot on paper on your balance sheet. That company does something to screw you, right? Even though you own a majority of that company does something to screw you, and then you want to fight it. They come to you with a settlement agreement, right? And then you know that if you don't take the settlement and you fight it, you will lose. However, if you stick to it on principle and you fight them, you will essentially be shouting to the world that your investment has become relatively worthless, because you will basically be revealing to the world that you don't own or control anything despite having a % controlling ownership. You see where I'm going with this? Then what would happen to the value on your balance sheet? What would you have to do? And then what would happen to your stock price in the short run?
The stock price would go down, and the balance sheet, you would have to write that value down.
Destruction of value on the balance sheet. Absolute destruction. So you have no choice but to take it and shout out to the world that you're happy about it in order to keep the value of that investment up.
Oh, okay. I get it. I get it.
So now I'm the CEO of SoftBank and Yahoo. I have to make sure that the world's like, oh, I really, really like it. I really, really like the settlement is great. It's a great settlement. I couldn't have asked for a better settlement. They just took something that was perhaps one of the most valuable pieces of Alibaba and just took it away. I'm super happy. That's them. Like basically with a figurative gun to their head.
Now I get it, because there's added nuance here.
Yes, with everything, there's so much added nuance. And that's what this channel is all about, is kind of taking that nuance out, not just doing the, for lack of a better term, very surface level analysis of things, right? The simple argument is to say, oh, they're happy with the settlement because they said they are.
Yeah.
The nuanced approach is looking at, really? You're happy with the settlement? You're happy with getting chump change for what perhaps is the actual value of that business? You'd be happy with that? Would you be happy with that, Austin? If I just took something from you now, and you know that in the future, it's basically is going to have a massive monopoly in some regards in a country, and I just took it for you, and I get, like, let's say I took away from you Amazon, and when it was selling at some market cap, I took it all away from you. For example, the addressable market is going to be huge, and the potential is going to be a $1 trillion business, and I just took it away. I took it away from you 20 years ago or 10 years ago. Are you going to be happy?
No, obviously not.
Why?
Because I own it.
Now, that's an extreme example.
I owned it.
This is an example of, for example, Austin is a CEO of a publicly traded firm. He makes an investment. The investment becomes a big part of his balance sheet. They screw him, and now he has to try to, sue them. But he knows he's going to lose because it's in a jurisdiction that always favors its interests over the interests of others, because you don't even have ownership rights, so they don't even respect that per se. And then on top of that, Austin has an incentive to just take the settlement and tell the world, oh, no, I'm very happy with it, because otherwise he's going to have to tell the world that his investment is basically worthless and he won't be able to sell it, and the value of his balance sheet will crash, right? And then therefore his stock price will crash, and he won't get his stock options. Poor little Austin won't make $100 million.
I know.
I'll be so he has upset. Every incentive under the nuanced approach to make sure the value of Alibaba stayed up. All right.
Okay.
Next point.
So now the answers to questions 4 and 5. Question 4, this whole VIE thing is basically a power struggle. China doesn't want foreign capital to dictate / influence their decision-making process in any way by foreign capital. Given the chaos the US has caused in other countries in the name of acting in US interests, quote unquote, I wouldn't blame China to be weary of China getting influenced by rich corporate capitalists of the United States. Question 5, to me, to invest means to buy stocks of great compounders, hold them for a long time, and hope for great returns in the future.
Okay, well, it only matters. The second part, it only matters if you have an economic incentive to receive those benefits, right? That's the whole point. You can buy a house and not being able to rent it and live in it is basically a worthless arrangement, right? What's the value of that? The only value is the next guy is willing to give you more money for that. That's what you're basically hoping for. And as far as the other argument, that's more of, I can't really get into that. It's kind of more of lines of like the belief that there is a zero-sum game in this sense. And the Chinese are equally doing that in the United States. I mean, they have equal ability to basically invest here. And they do buy a ton of real estate, for example.
Yeah, and they also buy a ton of companies too.
Yeah. So it's not really a non sequitur. It's called like this is essentially an arrangement in which one side is actually royally screwing the other, and the other side is completely allowing it for whatever reason. I won't get into it. But
you can see my displeasure with this, but
yeah. So China has an amazing situation because they are getting away with it. So like we're allowing them to get away with it. The rest of the world cannot get away with it. And that basically when you open up your markets like that, it's actually a fair game to anyone. Anyone can, by that logic, anyone can influence anything. So Russian billionaires can influence, American companies. Sure. We have Russian oligarchs who own basketball teams in the United States because we are a nation that basically allows these ownership, as long as you don't break laws per se. And we can get into discussion about, maybe the nuances of that, and maybe that's not fair. Maybe there's ulterior motives to that. Okay, sure, whatever. But the point is, we have more or less an open market system in the West in which individuals can own things and have property rights, right? And some people who maybe you can think of them as adversarial to the West are even allowed to own property in the West, which is the funniest part. So you can have people of countries that are wealthy in those countries that are adversarial to our countries own property in our countries. and we still respect those laws to an extent. I know maybe people can argue some things, but I understand that. All right. But the point is, in China has like a different kind of system. And my argument is an acknowledgement of that difference. And it is a deeper look at those differences. And then from those differences, drawing conclusions in which we can say one thing is not like the other. And I am arguing against the application of a lens to a system that is different. Okay, if we apply the Western lens and ignore these differences, we can come to the same conclusion. You are essentially, to use the metaphor of math, you're grabbing a different equation, assuming the same input, you are going to get the same output. All right, next point.
Yeah, that's actually the final point that we really have here for today.
Well, we have the other one. No, we have the other one. Awesome.
Yeah, no, I know. Just pause for a quick second. I have to go. Yep. All right. Well, our next point is it's another comment, and if this is a long one too, so feel free to stop me at any time. He says, I want to start by saying I do appreciate your take. Very cordial and respectful. We appreciate that. I appreciate the time you guys took to put this out here so that we could have a discussion about this. Nothing I say in response to this should be taken as a reason by itself to buy any company. I fully understand that I could be wrong. See also my ownership disclosure at the end of my comment. From my perspective, you guys are making the arguments that almost everyone is making right now.
All right, pause there.
Chinese companies, yes.
We're not, because what other people are saying is that the invalidation of the VIE is the risk, and that's not what we say. China will keep this for 1,000 years if possible. And if you understand our arguments, it actually makes sense why they would. Because if I have a deal where I can sell you something and give you nothing in return, and I get the cash to build myself up, why would I invalidate it? Point to me the incentive to invalidate that structure, and then we can have a conversation about that.
Yeah.
All right, continue.
So then to continue, Chinese companies are bad because you get a contract that says you'll get paid, which could ultimately not be honored.
Oh,
this seems to be more.
It does not say you will get paid. It says you have rights to the economic interest in proportion to what the VIE represents. However, there's no stipulation of when, so it could be 1,000 years from now, and you could still get a net negative capital return, and you still would not actually experience or an invalidation of the VIE per se by breaking contractual agreement. It could be 1,000,000 years, and there is no time stipulation. So no, that's not really the case. All right, continue.
This seems to be more of a confirmation bias among people who are uncomfortable with China, a common sentiment from Americans. I'm American too. What you all forget is that if one company out of China did that, it would hurt the ability for any Chinese company to raise funds.
Pause there. This is not a bond. This is not a royalty agreement. There is no stipulation in which they will break the agreement. Alibaba
therefore, they're not invalidating the structure.
They're not invalidating the structure. Yeah. They're not ruining the reputation of all Chinese firms. And by the way, if that was necessarily true, that they're all connected in terms of their reputation, then the fact that Chinese companies had all these accounting problems would be a sense elimination of the reputation for China. However, it's not. You may say that it contributes to them looking cheaper on paper because of those scandals. However, it's not something that you take for a fact that all of them are lying about their numbers. You see the point? So it doesn't really correlate. And on top of that, you may say that they look cheaper on paper because of it. But again, I'm saying looks cheaper.
A point that I actually want to add here too, it almost seems like we're kind of taking the Western lens and just applying like China.
Yep. Yes.
As just literally just China, instead of taking into account the nuance that each different industry or sector in China might be different from the other. So why would it logically make sense that if one did this, that would invalidate the rest of them, unless you're operating from that Western perspective that all Chinese companies are the exact
Well, no,
same.
You're operating under the perspective that the Chinese system is the same. And again, the point I'm making in this video is no, the argument I'm making is that they're different. And this is why you should think of it this way, because they are different. And you're applying the same lens to both systems, and then you're drawing similar conclusions. You're getting the same different equations and putting the same input and thinking you're going to get the same output.
Okay, so another here's the next point. Even Chinese citizens are barred from ownership in companies in certain sectors. If one contract wasn't honored, it would taint the deal for every contract. These structures are managed by an intermediary. Citi manages the ADRs for Alibaba. And then hold on. I don't think smarter investors than myself would be a growing number of buyers if they thought it could hurt them.
Okay, so second part, argument from authority. First part, it's an ADR of the Cayman Islands entity, not the actual entity in China. There's actually many different layers to the VIE. But the ADR, it's not the same as an ADR, for example, like Unilever. Unilever is an ADR from Europe, and that ADR actually represents legitimate shares in the business. The ADR for Chinese stocks are not representing the actual stock, right? The ADR is basically the custodian, right, is Citigroup in this instance, and the Citigroup is holding the Cayman Islands entity shares. And then from that, you are buying the ADR, which is BABA. So that doesn't actually say anything like that. And then the smart investors than yourself, which is an argument from authority, saying that is the reason why it's good. You should really think about that they're perhaps applying the same lens, which is actually a very common mistake among the entirety of the West of always kind of doing that with a lot of things, applying the same lens. And even the fact that legacy,
or also taking past events and extrapolating it.
I was about to say that.
Keyword, infallibly to the future,
Yes.
Such as when the market goes down, it will inevitably go back up.
Or like, the whole market or the big investors at the time were saying, no one's going to not pay their mortgage.
Yeah.
And there's plenty of other very intelligent investors saying the counter, and I'm not using them as a reason to say why I'm right. You see?
Yeah.
It's like other smarter investors are saying what I'm saying about China, the ownership structure, but I'm not using them as a reason to say I'm right. I'm explaining.
And that's also operating from the axiomatic belief that, for one, investing is about owning businesses.
Primarily, right? Yes, primarily. That's the
which as we've seen here, these individuals define it differently, by which there's no logic breaks, and we'll put out a video at a separate period of time. If there's no logic breaks, then your argument, you're logically consistent with what you're saying. But anyways, let's continue. Charlie Munger, Sven Carlin, Ray Dalio, Phil Town, Greg Alexander, and then Prem Watsa just got his feet wet, and the list just keeps on going. Investors sell for many reasons, but typically buy for one reason. These investors specifically are some of the greatest value investors in the world. I understand you want people to hear the bear arguments, and qualified this video by using the write down contradictory opinions down in 30 minutes or your brain will reject it. But you guys need to make sure then you aren't unintentionally misleading people with arguments that can easily be explained away with a small amount of critical thinking about cause and effect. And financial, actually, this is a separate part. So I'm going to stop at the cause and effect part.
All right. So I don't really understand the argument to be made in terms of explaining it away. I mean, simply put,
basically, okay. So what he's trying to say, I'm not trying to straw man his argument here, is that he's basically saying that we're operating from the position where we're like, just listen to what we're saying. Otherwise your mind will reject these things. Meanwhile, we're not taking into account that we could be wrong about this, and now we're potentially misleading people with things that could easily be explained away according to this individual.
Yeah, but I want to know what can be easily explained away. That's what I actually want from that individual to explain to me.
I think the entirety of his comment is him attempting to easily explain away all of our problems with investing in China.
I mean, no, you'd be absolutely correct if I didn't have an answer to what you were saying. So that's why I always look for people who counter opinions to my own, and then I look to see, can I counter that point fairly easily? And if I can't, then I really need to go back and think critically. So
Ant Financial is a non-issue. The simile you guys did with Amazon was mostly apples to oranges.
Okay, so
Amazon relies, hold on. Amazon relies on their web services business as a flywheel to generate the cash they use to do other things. And financial was not a critical part of Alibaba's business. And even now, Alibaba is attractive from a pure numbers perspective, which is, of course, just one part of the analysis.
Yeah,
it is annoying that if a spinoff happens, you do not get compensated. That is another reason it is critical to buy at very attractive prices. And then this is the next point after this, but basically just that entire thing about Ant Financial, which we kind of covered here.
Well, but Ant Financial does have a flywheel effect with Alibaba. It's actually one of the most valuable financial companies in the entire world. The fact that they just took that away from you is no small matter. It actually just shows that you control nothing, and entities larger than yourself as a retail investor were given the finger in terms of their ownership. Not only that, you also have the court cases that have ruled in the past to show you that they will treat you like garbage when it is convenient for them to do so, meaning that you are essentially just hoping for dear God that they will not do anything bad to you, or you're not in their ire at any moment. in time, and that they will use you up until they do not no longer need you. And now I'm getting into the meta side of it, because that's like the international politics of it. They will use you until they no longer need you, because they have not given you anything, and then you are at basically their mercy always. And then also they have promised you nothing, so they didn't break any rules. They didn't break any rules at all. Like, it's not a bond. You don't own a bond. You don't own a royalty. You don't own anything. You just own a arbitrary agreement with no stipulations that really can be held in perpetuity and never be broken. That's what I really want to get across here. There is no way that they break it. There's no way.
So now going into this next part, and this kind of has to do with elite capture. So this is going to be a fun little segment. He says, one of the main things I've seen that validates the VIE structure is Ray Dalio's opinion of China. He and Charlie Munger have spent a great deal of time in China and really do understand the culture better than we do. Z would have put an end to the VIE by now if he really had an issue with it, but he also knows that foreign investment is necessary for their expansion and growth of influence as a country. And then,
okay. So real quick on elite capture.
Yeah, this is his ownership disclosure, which I'm actually I'm not going to
say.
Yeah,
don't disclose that.
Yeah.
So
no.
The elite capture basically is, simply put, I can use an analogy of like companies and influencers. So take that, and then that's a microcosm of what countries can do. And China is very good at that on a macro scale. So they're able to identify key individuals. I'm not saying that Ray Dalio himself is captured. You won't know who is and who isn't.
Yeah, this is important to listen to what Fabio's saying with
very
the
careful
understanding of nuance.
Yeah, very careful.
Fabio is not accusing these people, but Fabio is more so saying just be cautious of these things, because there's been evidence of this in the past.
China's actually quite famous for this, because what they basically do in elite capture is basically drive sentiment. So that's a lot of their actual budget or spending every year. They actually spend and invest a lot of money in driving sentiment in Western nations or in the entire world. And then so they want the VIE system to continue. So they actually have to coddle you. They have to make you feel okay, make you feel good with it. And in fact, our videos are not going to be changing the industry. The industry itself is so big. There's so much money at behest and incentivized to actually push these VIEs that we're not going to make any dent. If we were going to make a dent, they might actually would come after us. But we're just, trying to get that small group of people that are going to be listening to this and kind of getting them to think critically about everything we've mentioned. And hopefully they can kind of see that. And we're actually like hoping to, save some people from perhaps making a big mistake. But everything I said actually up until this point does not actually take away from the fact that these stock prices will go up, or will probably end up going up, because the Chinese government, again, wants to coddle you. So they will do everything in their power to actually make you feel okay with owning these VIEs, which is why I'll actually get to the surprise. But actually, Austin, if you need to leave us, we'll get to finishing this questions, and you'll have to watch this video yourself, and you can leave us and you can go to your meeting, because I know that's a pressing matter. So do not worry.
Yes.
So let's finish the comments.
Before we do that, I'm just going to read this last part here, and then you can offer some thoughts. And then, I have to go.
You go to your meeting.
Here, right. But personally, I don't see what's wrong with forming opinions from a position of authority. I believe you mentioned that you consulted subject matter experts for your understanding of the legal precedents. That is the same thing. You do not personally understand how the Chinese civil law system works and look to someone else to tell you. Now you're using your understanding to tell us. As someone who knows a little about the legal system, I can tell you that the mere mention of precedent suggests your understanding of China's system may be flawed. Our system is what's known as a common law, where legal precedent is important. Past judicial opinions and rulings are given more weighting in making decisions in the future. The Chinese have a system that pays more attention to their statutes, known as civil law. The key difference here is judges in China are given more leeway to make their own decisions independent of past rulings and opinions.
All right. So quick comment on that second part. That should make you even more terrified, because for example, the markets don't like unpredictability. So for example, in the United States, you'll hear that a lot. You'll see that the markets are kind of not liking the unpredictability of a political outcome, et cetera. So imagine that turned to 11 and given steroids. That's Chinese legal system, because basically what it means that you're subject to the whims of whatever the heck the guy in power decides, and who is in power actually can vary between the judges, et cetera. But they more or less toe a political line because it's a one-party system.
Yeah, let me actually cut in here too for a quick second. We're not trying to say that the Chinese law system is bound by precedent the same way the U.S. law system would be. what we're trying to say is that there is precedent to suggest that what we're saying could potentially
Yes.
happen in
Not
the
legal
future.
precedent. Yeah.
Yes,
Basically,
it's
it's
not
like
legal precedent.
if
Yeah.
something has happened in the past, we are saying that, look, it's happened in the past. Do not think it won't happen in the future. And
Yeah,
that's
just
we're
be
referring
cautious. You know, it's the same thing. We're not accusing Ray Dalio of elite capture. We're just saying
to caution.
be cautious. Yeah.
Listen to what he
You know?
says and think critically about what he says. Don't just take it and eat it. Right.
Yeah.
So what we're referring to with the quote unquote precedent, not the legal precedent, because we understand that it's not there's not a common law system, was the Supreme Court cases in China that basically ruled that the owners were not owners because they're not owners, simply because the actual contract even stipulates that they're not owners, right? So because you're not an owner. Okay. So, and then they were actually given nothing. It gave them no recourse because they had no ability to defend themselves in court, especially like the very fact that you think you can even win in a Chinese court against the Chinese entities is actually hilarious, which makes it worse, not better. Okay. So that second point is even a more of a stance at which you should be cautious about investing in China than being positive about investing in China. Just because the courts can now be invalidating each other makes things way worse.
Yeah. So now kind of moving to the first part of this question, which is I don't see what's wrong with forming opinions on a position of authority, going into the subject matter experts, how that's an argument from authority. Is that an argument from authority? Because under my understanding, an argument from authority would be something like, I am a musician, therefore, this is the only way that you can play guitar.
Yeah,
this is the only way that you can sing. That's a logical fallacy. That's an argument from authority. Not getting information from subject matter experts or consulting with industry professionals and then forming
constructing and forming. That's the key. Construction and forming an opinion from evidence that can be presented by subject matter experts. Now, simply saying, I take a statement by a subject matter expert and I say, this is true because of this. You see, like we have not done that at all in this video. We've formulated a structured argument, right? This video would be very short if it was arguing from authority. We would simply say that we are right because I work in the industry and I say this is the truth, right? Clearly, that no one would listen to that because it's a clear invalidation of logic because it's an argument from authority. That's a more extreme version of argument from authority. But you got to be careful of how you make your arguments or how you make your justifications for an investment, because if you're using logical fallacies to justify your investments, you're building your house on sand. Okay. Yeah. You're really building that house on sand. If you're saying I bought this stock because this person bought the stock. Remember, the cloner theory really it can work. However, you have to understand the business as well. You have to have some semblance of an understanding, because the problem with the cloner tactic, if you're taking it to the extreme version, which is simply buy whatever that person buys, you don't know their strategy. They could have a very complicated strategy that you're not aware of, right? They could have hedges that you're not aware of because, you know, for example, in the 13F filings, you don't have access to, for example, some of their positions, right? You have access to some positions, but not all their positions. And you don't have the precise timing of those positions, which makes it very problematic. So if you do not understand the business and you don't understand what can go wrong and when can go wrong, and you don't have the adequate hedges against that position, then you are going to get screwed, right? And then why did you get screwed? Argument from authority. You said, I'm going to buy it because that person bought it, right? And then deservedly so, you know, you can get screwed, but you can also be right. And like we say in this channel a lot, you can be right for the wrong reasons. And that's just as bad, if not worse, than being wrong. It's very damaging. Howard Marks talks about that. It's very damaging to be right for the wrong reasons, right? It is a good lesson to be wrong and be proven wrong than to be right but be wrong on why you were right. It's just as bad. Yeah. So again, I can say
you're building that house again out of sand.
I highly believe, and this is Austin having to go, but I highly believe that the Chinese will perform actions that will bring up the stock price. All right, Austin, you're gonna have to watch this part of the video to see what the surprise was.
I will, especially too if I don't end up getting on editing duty. So
no, for this one, I got this one.
All right, cool. Yeah. All right, okay. Well, you've heard it here, folks. I'm your host, Austin, and I got to go. So take care, guys.
All right. So for those of you who are sticking around, I have a little bit of a surprise. Basically, it's going to be an expensive experiment. Well, not really for me in this case, but it's going to be an expensive experiment. I'm going to be plowing in about, I'd say, $10,000 each into Tencent and Alibaba. And so $20,000 total. So less than, I think that's going to be about 1 point something percent, something like that of the portfolio. So if it goes to zero, I won't care, but it will just be following the position. And basically, I'm doing so to kind of showcase that I actually do believe the Chinese may, in fact, perform actions that will lift the stock price up, but it's also in complete understanding that I know I own nothing, and I'm just going to buy it and then hope stock price go up. That's the thesis. But for those of you who took everything I said and have that axiomatic disagreement with me about what investing is and ownership structure, I will actually show us in the model what it says about Alibaba. And I'll say, spoiler alert, the model actually says Alibaba is a fantastic investment. So I will use the model today to kind of justify my investment if it was a standard investment. But again, I hope so far the video has explained the greater nuance to this entity and why it's not all what it seems. Okay, so let's actually take a look at, let me actually open it up. All right, so this is a longer video. I'm aware of that, but I hope that you guys find a lot of value in this video because we're answering a lot of questions. So let's actually plug in Baba. And I think we can discount this puppy at 20%. Okay, so we're going to use custom weighting. Actually, let's say no, let's use the standard weighting. Okay, so let's take a look at what analysts believe. So analysts believe this thing is a strong buy, price target of 278, implying 130.5% upside. All right, let's just go off the whims of the analysts because, you know, investing is that easy. And I'm joking, of course, if you can't tell. And let's assume, heck, let's assume those buybacks are just permanent. They're going to continue the buybacks. I'm going to ignore that they've, diluted us on average. And 15 billion is really chump change in the grand scheme of things for the size of this business. Let's just, take that. Let's do a buyback. And let's say they're doing a 1% buyback per year because we're OGs like that. And we're going to get all that moolah. And so average growth rates over the past years is 40%. Let's go with 30%. All right, boom, right there. Then let's go 25% and let's go 20%. Let's go 10. And then let's go, actually 10 should be our low. And then we'll go 15. Okay, so discounting it at 20%, very hefty discount. I'm going to be arriving at a weighting or recommended weighting of 2.27% of the portfolio based on the assumptions. If I lower my discount rate, and let's use an everything money level discount rate, yeah, just buy across the board, just buy as much as you can because you're probably going to experience that rate of return. And then this is all ignoring what I said before, and just assuming that the fundamentals are actually connected to the stock price. My model is saying buy this hand over fist. So what I want to do then, discounting at this level, I want to just show everyone how cheap it really is at this discount rate. It's extremely cheap. It's incredibly cheap. All right. This is the deal of a lifetime, ignoring everything I said. And I wanted to show this to you because, for those of you who just, think I'm just absolutely wrong, the model is telling me, based on the fundamentals, applying the same framework that you would to every other business in the world and applying it to Chinese stocks. I want to show you everyone that yes, it is cheap. Yes, it's a buy, but you're ignoring the nuances. You're ignoring the nuances, and I will suffer alongside you or benefit because I actually do think the VI stock price will go up. Because I do think the Chinese will do it. And for the followers who feel bad, and I've seen your comments before that you invest in this company, now that you know the greater nuance, you're kind of regretting it. Don't worry. I mean, it's no guarantee, but I do really think that the Chinese are going to coddle you. They're going to be like, oh, don't worry. You're an owner, pat you on the head and stuff and give you a cookie. So they're going to want the validation of the West and say, okay, like, yes, I'm an owner in this. I want to invest more and more money into these entities. So, okay, we're gonna find out together, and we're gonna have 130% return, according to that price target and that analyst strong buy rating. All right. Anyway, enough of being facetious about it, but let's discount it at 15%. You see how cheap this thing is? So cheap, so freaking cheap. Let's discount it even higher at 17%. Oh, so cheap. It's still a buy. Still a buy. So based on that, if you really want to achieve that 17%, you see all the models basically saying allocate lower because of the risks of really achieving that, because you're increasing your margin of safety. But if your goal really is, you can think about it in a different way. If your goal really is like 12% and you're discounting it at 17%, you have that added margin of safety. But if you want 17%, this is where you have no margin of safety, and then you're implying a lot of different risks. And remember, you have that. So I'll actually point to another thing. So in my opinion, this discount rate is meaningless because I can't discount something I can't own, right? So this model actually lacks the nuance, because that's why I repeat in some of our videos, this is a tool, right? This is not a crystal ball. This is a tool that allows you to become or makes an investor a better investor, but it does not make a good investor. So this tool lacks nuance, and it can't replace a human in terms of understanding nuance, right? So that being said, like if I'm ignoring the nuances and I'm just going off of, again, I'd say not to offend anyone, but it's a very simplistic argument. I'm going to apply the same framework of the West to the Chinese companies. This is a screaming buy, and I'm not going to plug in Tencent because this video is way too long already, but Tencent's about the same. So I'll be putting 10 grand into each company, and then we'll kind of see how they go. This is going to be like a little bit of an expensive experiment, but it's not going to be, it might be about like, yeah, it might be about this percentage of my portfolio. I don't really know. I'll find out, and I'll get the final calculation out once I make the trades. Yeah, that's pretty much what I wanted to say. That's the big surprise. So I will be a shareholder in Alibaba before today's close of Thursday, 12/2/2021. So that's when we're recording this video in the market open. So I'll be buying it around $120.94 a share. All right. On that note, guys, thank you guys for watching so much. And if you guys like the video, please like or share the video if you want to show this to anyone who may be super bullish on Chinese stocks, maybe wants a different approach. Tell them to stick to the end, because in the end of the video, I do give this financial analysis where I do kind of validate their perhaps their opinion about that this company is extremely cheap. It is extremely cheap based on the fundamentals, if you can connect the fundamentals to the actual stock price. However, as we've addressed in some of the comments, and there may be different beliefs on what investing is, and how an acknowledgement of not owning this, right, is irrelevant. And I'm going to be buying the shares based on the premise that stock price go up, and my belief that the Chinese government will in fact want to coddle the VIE holder so that they don't lose the ability to raise capital at basically zero cost. So with that being said, that's the end of the video, and thank you guys so much for watching. Have a good one.